All right, Canada, let's rip off the Band-Aid. You've heard the headlines. Sales are stabilizing. Rates may fall. Affordability is improving. Here's the truth. This market isn't recovering, it's surviving, and just barely. We've got sliding home prices, condo inventory at record highs, construction stalling, and new policies on deck that could throw fuel or fire on the entire thing, depending on who's driving the truck. This is the Wise Old Owl Show. I'm Vince Gaetano of OwlMortgage.ca, and today we're digging into what's really happening in the Canadian housing market from Vancouver to the 416, and why the next 12 to 24 months might be the most volatile ride this market's seen in a decade. Let's start with Toronto, Canada's bellwether market. Seasonally adjusted home sales ticked up 1.8% in April, a modest bump after a brutal 27% drop in the 2 months prior. Sales still down 21% year over year. Condo sales in the 416 down almost 30%, the second lowest April in at least 25 years, second only to the 2020 lockdown. Single family homes, same story, 20-year lows in sales activity. This isn't a rebound, folks. This is a flat line with a weak pulse. You're not hearing this on CP24, but prices are down across the board. MLS Home Price Index, seasonally adjusted, down 1.6% in April. Detached homes, condos, and semis, red ink everywhere. Townhouses in the 416 were the only exception. And yet, confidence is the real problem. Ben Robideau called it, affordability is improving, sure, but what's missing? Sentiment. If you don't believe prices will stop falling, you won't buy. That's what's driving this freeze, not just interest rates. Now here's the jaw dropper. Active condo listings in the 416 are up 83% year over year. Inventory across all segments at 20-year highs. Months of inventory in condos, just under 7 months, the highest ever recorded. We're not just overstocked. We're looking at the market flooded with units, many of which can't be rented, let alone sold. And guess what? Rental listings just hit an all-time April high. Over 16,000 active rentals. Condo investors, I hope your cash flow model includes Dramamine, because this ride's about to get rough. Condos under construction, plummeting. New condo starts, down 70% year over year. Condo starts in March were only 160 units, down from 3,500 in 2021. Overall under construction inventory dropped 5.7% last month. If you think supply issues are bad now, wait until 2027 when there's nothing left in the pipeline. We're heading into a delayed supply trap. Too much now, not enough later. So what should Canadians expect over the next 12 to 24 months? Let's break it down. Interest rates. The Bank of Canada might cut rates in June. 25 basis points is on the table, 50-50 odds. If that happens, monthly payments will drop to their lowest point since March 2022. But the real driver of recovery? Confidence, not just cost. We got a new federal government. The new mandate includes the revival of the multi-unit residential building program. MERB is the acronym. A tax shelter aimed at rental development. Sounds great, unless you're a mom and pop investor now, forced to compete with high-income Canadians looking for tax breaks. Not cash flow. Tariff tension? U.S. trade tensions loom large. If tariffs escalate, economists say we could lose up to 4% of GDP. Vancouver, sales down 24% year over year, fifth straight monthly drop. Inventory at its highest since 2014. The home price index fell 1.5%, the biggest decline since mid-2022. Edmonton, surprisingly strong, sales now surpassing Calgary, but even there, signs of topping out, new listings rising, price growth slowing. Calgary, price declines showing up for the first time since 2020. Construction still strong for now. The moral of the story, no market is immune. The softness is spreading across the country. Now, what do you do with all this? Tip 1, renew strategically. If you're renewing this year or next, start planning now. Don't just sign the bank's offer. Work with a broker, to explore blended midterm and early lock-in strategies. Tip number 2, invest with eyes open in the condo market. Be cautious. Look for distressed opportunities, but know the numbers, especially rental cash flow. Detached homes, that market will tighten again first. Watch for windows in late 2025. Tip 3, keep your powder dry. Whether you're a buyer, investor, or developer, maintain liquidity. Deals are coming, but if you're over-leveraged today, you'll be sidelined tomorrow. Canada's housing market isn't collapsing, it's correcting. And what comes next depends on confidence, competence, and yes, a bit of courage. Tariffs, policy shifts, interest rates, they all play a role. But what matters most is whether Canadians start to believe in this market again. Until then, buckle up. The turbulence is just beginning. Like this video, share it with someone in housing purgatory, subscribe because we're giving you the truth before it hits the headlines. You're here, you're watching, you want facts, not fluff. This is Vince Gaetano from Owl Mortgage. Thanks for listening, and remember, the wise old owl is here to help you navigate through the noise and provide insight to the financial chaos in the current environment. Stay informed, stay vigilant, and together, let's chart a path to financial stability. Cheers.